Financial experts and leading economists are sounding the alarm. A major economic downturn is forecasted to strike between mid-2026 and late 2027. This isn't just speculation or fear-mongering. These warnings are grounded in rigorous analysis, hard data, and unmistakable historical patterns that have preceded every major crash in modern history. The signs are becoming impossible to ignore, and the consequences could be far-reaching for individuals, businesses, and entire nations. Analysts are poring over mountains of economic data, comparing today's numbers to those from previous crises. The patterns they're seeing are eerily similar to the lead-up to the Great Depression, the dot-com bubble burst, and the 2008 financial meltdown. These aren't isolated red flags, they're part of a larger interconnected web of warning signs. In total, 14 key economic signals are now flashing red, just as they did before the catastrophic crashes of 1929, 2000, and 2008. These indicators include plummeting consumer confidence, rising corporate debt, and unsustainable asset bubbles. Each one on its own is concerning, but together, they paint a picture of an economy teetering on the edge. The next 18 months will be absolutely critical. Investors, business owners, and everyday people must use this time wisely to prepare for what could be a turbulent period. The decisions made now could determine financial security for years to come. The convergence of excessive debt, dangerously overvalued markets, and underlying economic fragility is creating a perfect storm. These vulnerabilities are not isolated. They're feeding off each other, amplifying the risks, and making the system more unstable than it appears on the surface. When viewed together, these indicators form a comprehensive and urgent warning. The global economy is on the brink of a significant correction, if not a full-blown crash. The warning lights are flashing brighter than ever. History has shown us that ignoring these signals can lead to devastating losses, widespread unemployment, and years of hardship for millions. The pain of past crashes still lingers for many, serving as a stark reminder of what's at stake. In this video, we'll break down each of the 14 warning signs in detail, explaining how they interact and why so many experts believe a crash is not just possible, but likely. We'll also explore what you can do to protect yourself and your loved ones. Understanding these risks isn't just important for investors and policymakers, it's essential for anyone who wants to safeguard their future. Knowledge is power, and being informed is the first step toward resilience. Our goal is simple: to equip you with the knowledge and strategies you need to navigate the coming financial storm. With the right information and preparation, you can weather even the toughest economic challenges. So let's dive in, examine the evidence together, and learn how to prepare for what's ahead. The time to act is now. Today's economic signals are sounding alarm bells that are eerily reminiscent of the periods leading up to the infamous crashes of 1929, 2000, and 2008. If we look closely, the patterns are strikingly similar: rising asset prices, record-breaking market highs, and a sense of invincibility that often precedes a fall. History has shown us that when markets become detached from underlying economic realities, trouble is never far behind. Overvalued markets and excessive optimism have historically preceded major downturns, and we're seeing both now. Investors are pouring money into riskier assets, convinced that the good times will last forever. This kind of exuberance, while exciting, can blind us to the underlying vulnerabilities that are quietly building up beneath the surface. Debt levels, both corporate and consumer, are at dangerous highs, echoing past crises. Households are taking on more credit, and companies are leveraging up to finance growth, just as they did before previous collapses. This mounting debt creates a fragile foundation that can quickly crumble if economic conditions shift. High leverage increases the risk of defaults and bankruptcies, threatening systemic stability. When too many borrowers are stretched thin, even a small shock can trigger a wave of financial distress, leading to layoffs, business closures, and widespread economic pain. Investor and policymaker complacency is also eerily familiar. The belief that this time is different has proven costly before. Despite mounting risks, many decision-makers remain confident that the system is resilient, underestimating the potential for rapid change. Ignoring these red flags has always led to severe consequences. The aftermath of past crashes has included lost jobs, evaporated savings, and years of economic hardship for millions. By recognizing these patterns, we can take steps to protect ourselves. Staying informed, diversifying investments, and maintaining healthy financial habits are crucial defenses against uncertainty. The warning signs are clear. Action is needed. Now is the time to reassess our strategies, question assumptions, and prepare for potential volatility ahead. Let's break down the parallels between past and present and explore what they mean for today's investors and the broader economy. Throughout history, financial markets have shown a remarkable tendency to repeat themselves, especially when it comes to dramatic downturns. Market crashes, while each unique in their details, often unfold in a recognizable four-stage pattern that has played out time and again across decades and continents. Understanding this pattern isn't just for historians or economists. It's a crucial tool for anyone hoping to navigate the uncertainty of today's markets. The first stage is marked by excessive optimism and rapidly soaring asset prices. Investors, buoyed by recent gains and positive news, pour money into the market, convinced that the good times will last forever. This is where we find ourselves now. Confidence is high, and many believe the only way is up. In the second stage, subtle warning signs begin to appear. Economic data may start to soften, or troubling headlines might surface, but these signals are often dismissed or rationalized away. The majority of investors caught up in the prevailing optimism ignore these early red flags, missing the opportunity to take protective action before trouble hits. The third stage is triggered by a sudden, often unexpected event. A major bankruptcy, a geopolitical crisis, or a sharp policy change. This event shatters the illusion of stability, sparking panic and a rapid, steep decline in asset prices. The market's mood shifts almost overnight from euphoria to fear. In the fourth and most painful stage, forced selling takes over. Investors, desperate to cut their losses or meet margin calls, sell en masse, driving prices even lower. Widespread fear and uncertainty grip the market, and the effects spill over into the broader economy. Businesses close, jobs are lost, and entire communities can feel the impact. Recovery from such a crash is rarely quick or easy. It often requires significant intervention from central banks and governments, through stimulus packages, interest rate cuts, or other measures, to restore confidence and begin the slow process of rebuilding the economy. By recognizing this classic four-stage pattern, investors and everyday people alike can better anticipate what might be coming next. It allows us to spot the signs early, make informed decisions, and avoid being caught off guard when the cycle inevitably repeats. Right now, we're in the early stages. Optimism is high, and many warning signs are being overlooked. It's a time when caution is often dismissed, but history tells us this is precisely when vigilance matters most. The next trigger event could come from anywhere: a sudden policy shift, a global conflict, or a major corporate failure. When it does, it could set off the chain reaction that leads to the next crash. Understanding this cycle isn't about predicting the future with certainty, but about being prepared. By learning from the past and staying alert to the present, we can take steps to protect ourselves and our financial futures, no matter what comes next. Markets are more overvalued now than before the 2000 and 2007 crashes. The Buffett indicator is at 230%, more than double its historical average. The Shiller-Cape ratio is near 39, far above its norm of 17. These metrics signal a dangerous disconnect between prices and fundamentals. Historically, such overvaluation leads to sharp corrections and major losses. When the correction comes, it could be swift and severe, erasing trillions in wealth. Investors must recognize that high valuations can't last forever. Ignoring these signs has proven disastrous in the past. Now is the time to reassess risk and prepare for a potential downturn. Debt across the board is at record highs, threatening economic stability. Margin debt is near $800 billion, levels last seen before previous crashes. Corporate debt has soared to $14 trillion, much of it due for refinancing at higher rates. Rising interest costs could trigger defaults and bankruptcies, especially among over-leveraged companies. Consumer debt exceeds $18 trillion, with credit card balances at $1.2 trillion. Delinquencies are rising. High debt makes the economy fragile. Any shock could set off a crisis. History shows that excessive leverage is a recipe for disaster. Understanding these risks is essential for anyone hoping to weather the storm. Regional banks are dangerously exposed, especially to commercial real estate. They hold $1.3 trillion in CRE loans, with office vacancies and property values plunging. Recent bank failures highlight unresolved weaknesses in the system. With $1.5 trillion in CRE loans maturing by 2027, widespread defaults are likely. Losses could exceed $600 billion, threatening bank stability and the broader financial system. The interconnectedness of banks means a crisis could spread rapidly. Past crashes show that banking failures can trigger wider economic collapse. Addressing these vulnerabilities is urgent to prevent a repeat of history. The time to strengthen the banking sector is now. Consumers are stretched thin. Debt is at record highs, while savings have plummeted. The personal savings rate is just 4%, far below the historical average. Rising delinquencies show many are struggling to keep up with payments. High debt and low savings leave households with little cushion for economic shocks. If a downturn hits, consumer spending could collapse, deepening the crisis. Consumer vulnerability is a key risk to the broader economy. Supporting households now can help mitigate the fallout. Here's what the next 2 years could look like. Early 2026. Markets stay high, masking underlying risks. By mid-2026, a trigger event, like a major bankruptcy, could spark a sharp sell-off. Stocks could drop 35 to 45%, with unemployment spiking to 7 to 9%. The market may bottom out by late 2026, with the S&P 500 falling to 2,700 to 3,500. The Fed will likely cut rates and restart quantitative easing to stabilize the economy. Recovery will be slow, beginning in 2027 as confidence gradually returns. Understanding this timeline allows for better preparation and response. Proactive measures now can soften the blow and speed up recovery. The warning signs are clear. Now is the time to act. Reduce exposure to risky assets, increase savings, and avoid excessive leverage. Diversify your investments and focus on long-term resilience. Stay informed and be ready to adjust as conditions change. Those who prepare are best positioned to weather the storm. History rewards the proactive, not the complacent. The pattern is clear and there's still time to get ready. Take action now, before it's too late.